Okay, good evening, class, and welcome to our first Zoom revision lectures for this diet. My name is Chima, and I'll be one of the lecturers that will be taking you on your revision class for this diet. All right, we'll be going to the very basics of taxation. So the topic I have chosen to teach us today is taxation of business income. So we'll be talking about basis period of companies and businesses. Okay? Now, before we start our class for today, let me acquaint you with our class rules. These are rules that we would like you to follow. The first and perhaps the most important is that all students should mute their audio. Okay? In fact, I'm ensuring that you all get muted on your audio so that you don't distract the class by putting on your audio. If your audio is on, it's as good as making noise in the class if it were to be a physical class. So that will not be welcomed. Also, we want you to try as much as possible not to on your video. You don't need your video on to enjoy the class. Only your video is synonymous to standing in front of the class along with the teacher. And so they are seeing two people teaching. To distract other students, to also distract the lecturer. So please don't on your video. Now that is within your power so that you can help us in that regard. Also, this class is being recorded. And so it will not look good for you to on your video just because you want to participate. So we'll be happy if you follow that rule so much. Now, you'll be wondering, how will you ask question if nobody is seeing you or nobody is hearing you? It's easy. Use the chat button. Type your questions and I will answer that question. If it is something that will be answered immediately, I will do that. If it is something that will be answered at the end of the class, I will do that. So it's a matter of judgment to see which is the best time for me to answer that question, but I will answer all your questions. Now, if you do not have any questions during the Zoom class, you can ask the question in the WhatsApp class where you get the link to join the Zoom. So all your questions will be treated. Now, when asking questions, please be professional as possible. And one way of being professional because I may not be able to understand Sorry, I had to change direction because the other side is giving me issues. So sorry, let's continue. Okay, so you're all welcome to our class. As you keep to these rules that we have set here, we'll be sure to answer every of your questions. So there are about 30 students in the class, so I'll be happy if all of us will go home today with something. Now, most of us, if not every one of us, were exempted from basic taxation because we were exempted from foundation class. And so some of these basics of taxation has gone off our mind, or some of us are finding it difficult, struggling with it. So if you don't know the basics of taxation, how can you do advanced taxation? So we are going to tell you about the basis period for accounting for business income. When we say business income, we mean income derived from trade, income derived from profession, income derived as a sole proprietor, as a partner in a business, or as a limited liability company, as an example. Now, the basis period for assessing the tax of business income is the preceding year basis. Now, by preceding year basis, we mean that if the year the tax office is assessing you to tax is called tax year or year of assessment, they are going to be looking at the books of the year immediately before the tax year. That is called preceding year basis. Let me give an example of something similar. Now, for those of us who are still using NEPA estimated bill, now when NEPA sends you your bill, let's say on the 11th or 10th of November, or today is 11th of November, and they sent you a bill, they will call it November bill, isn't it? Okay, they will say it's October bill, but they sent it to you in November. And it's a bill related to your usage of light for October 1 to October 31st. Now, what they are doing is preceding month basis. So they sent you the bill in October, in November rather, and it relates to October usage, preceding month. So we are using the same principle. Preceding year is the year just before the year that they come to inspect your books or they assess you to tax. And the year in which they are assessing you to tax is called the tax year. That is the year you're supposed to pay your tax. That is when the tax people are expecting you to comply. That is called the tax year or the year of assessment. Now, normally, there is going to be preceding year basis. That's a normal thing the tax office does. But there are some abnormal situations in which it is not feasible to look at preceding year basis. And so we're going to be considering 3 abnormal situations. I call them the 3 C's. The first one is commencement of business. The second one is change of accounting dates. And the third one is cessation of business. Now, whenever you are registering your business, the date you intend to commence your business, the date your business is going to be commencing. So there is a difference between the date of incorporation of your business and the date of commencement of your business. Now, let me give you the example. Okay, let's say Go Getter Professional Consult is a business concern, and it was registered with the CAC, for example, on November 27, 2019. Let's say, for example, and it commenced business on January 1, 2020. Now you see, the date you registered your business, the date that is in your certificate is the date of commencement of business. It has nothing to do with your tax. Now, when you are commencing your business operation, that is the day you start counting. Now, what is the rule governing commencement of business? Okay, I'll have to tell you something before I proceed. Our class today is not about the new finance rule or the new Finance Act 2019. We will not be discussing it. So for the moment, just assume that the Finance Act 2019 is not existing. For the moment, just assume that. So we're going to be using the old Finance Act before 2019. Okay, so let's continue. The commencement rule says that whenever a business commences, the date of commencement is important, and you are going to use the date of commencement twice. Another important date is the date the business is making up its accounts. Now, that is another vital date. So what is your rule? The first year of commencement of business, you start from the date the business commenced and make your account up to December 31st of that same year. So you see, year one of your commencement of business, it is not feasible to use preceding year basis because the year before you didn't do any business. So you use what they call actual year basis for year one. For year two, you go back to use the same date the business commenced. But this time, you're going to be counting 12 months, 12 full months, exactly 12 months. So like in exercise 1.1 that is showing on your screen now, the date the business commenced is April 1, 2006. And they are making their books up to June 30th every year. Now, let's leave the figures alone. Let's look at the dates let's look at the dates. Now look at, okay, somebody's asking a question. I said we are not going to talk about the new Finance Act. So if ICANN is still using the old syllabus in December exam, the old syllabus does not make provision for the Finance Act. But if you want to learn about the Finance Act just for current issues, feel free. But just know that the discussion tonight is not all about the Finance Act. Okay? So it's important if you want to know, but for tonight's class, it won't be. So let's look at the date before we go to the calculation and workings. Now, for this day the business started, April 1, 2006, that is the first year. The first year is 2006. So you identify the first year from the date the business started. So that is what we put here, year of assessment 2006, and you see it here, it is year one. The basis period begins from the date the business started, April 1, 2006, and it goes all the way to 31st December 2006. That's the rule. Actual year basis. By actual year basis, it means any year that any date that corresponds with the actual fiscal year that the government is assessing you to tax. So you see, they came in 2006 and your books is reading 2006. What about the second year? The second year, which is 2007, you are also going to go back to the date the business started. And this time, we are going to count 12 full months. Okay? Some of us used to count our fingers. We will say April, May, June, July, August, September. But there's a faster way to doing it. What I normally do is, if I'm counting 12 full months, and this is April 1, 2006, I ask myself, what was yesterday's date? If today is April 1, yesterday's date will be March 31st. So I will just come here and say I will put March 31st as the ending date. Then I will increase the year. Instead of 2006, I'll make it 2007. So that way, you are not counting fingers, especially when time is involved. But feel free to count your fingers. You are counting 12 full months. Now, the third year, that is when this accounting date becomes very, very useful. So you see, in the first year and the second year of business, we ignore the year, the date in which the account is made up. But in the third year, you can't ignore it, except something happens. So if you look at it, in the third year, they make the account June 30th. So what's the third year? The third year is 2008. Okay? So this is the rule for the third year. It is the third year that the preceding year basis actually begins. So you see, how do you know something is preceding year basis? Now, if you look at this year of assessment, you see it's 2008. It means that your account must end in 2007. Now, that is how you achieve preceding year. Your account ending the year before the tax year, 2007. Now, that's the first thing you put. Then you look at what is the date the business is ending its account, 30th June. So I've combined 30th June 2007. Now, it will help you to start with the ending date first so that you get it right. So how you do it is look at the tax year. The year the account will end will be 1 year before, that is 27. What date are they making their account? 30th June 2007. And now you're going to go back by 12 months. Okay, so instead of counting backward, June, May, April, sometimes you count 2 times. What I normally do is, if I am standing on the ending date, June 30th, 2007, I ask myself, what is tomorrow's date? Tomorrow's date is July 1. So I just take it here, July 1, then I move the year 1 year backward. So it's opposite of what we did when we are starting from the beginning. If we are starting from the beginning, I am starting from April 1 to 6. I ask myself, what was yesterday's date? Yesterday's date is assumed to be ending of another period. So it's likely going to rhyme with the ending of this same period. So I ask myself, what was yesterday's date? March 31st, and I put 1 year forward. Now, if I am starting from the ending, I will ask myself, if I'm at the ending of June 30th, 2007, I want to go to the beginning. I will ask myself, what is tomorrow's date? Because I know tomorrow is also the beginning of another period, and it will rhyme with the beginning of this period. So tomorrow's date is July 1. So I take my July 1 and I put it here, and I move the year 1 year backward. So that's how we form the dates. We'll come back to the workings. We'll come back to the workings. Now, for the commencement of business, the law says that the taxpayer has a right to ask the tax authorities to assess year 2, which is 2007, and year 3, which is 2008, based on actual year basis. So far, it's going to result in a favorable tax for the taxpayer. Now, why are the taxpayers asking the authorities to do that? The reason is because in year 1, it was actual year basis. And so the taxpayer will say, okay, why don't you tax me year 2, actual year basis, year 3, actual year basis. And let's see, if it's going to favor me, I'm going to opt for that. The tax authority will say, no problem, we will do that, we will honor your request. And so what happened? How do you know if it is going to favor you? You are going to sum year 2 and year 3 figures. Which are these figures here we got? We'll come back to how we got it. This figure plus this figure, sum them up, and you got 2,880,000. And you are going to compare with the right of election year 2 and year 3. You sum them up, and you have here, when you sum them, 3,120,000. And you say, oh, this is higher. This right of election is higher than the normal basis. And you will say, I don't want to opt for right of election. Please let me allow the FIROS to continue taxing me the normal way. So you see, for the 2007, if you are opting for right of election, you are saying it is actual year basis. And what is actual year basis? It is January 1 to December of that same year. So how do we know actual year basis? Year of assessment is 27. The account is ending in 27. It is also beginning in 27. January to December of the same year. The same thing goes for 2008. It's going to be January to December of that same year. That is how we know actual year basis. Now let's go to the calculations to see what we actually do when we calculate this basis, right? This commencement rule. Okay. Now look at. Let me go back to the question and show you the answers at the same time. Now the question here says period. The first year they give you period ended June 30th, 27. Now you see this accountant or this company were always bringing their account ending June 30th, and that's beautiful. Now ask yourself, whenever you see the word period ended, it means it's not full 12 months. It's either shorter than 12 months or longer than 12 months. But when you see the words year ended, you know it's exactly 12 months. Now, period ended. When did this period start? Because you are saying period ended. When did this period start? Of course, it started April 1, 2006. And so, going to the basis, we need account from April 1, 2006 to December 31st, 2006. But here, we are having April 1, 2006, all the way down to June 30th, 2007. How many months are in this period? How many? Okay, from April to June is how many months? Is 3 months. From July 2006 down to June 2007 is another 12 months. So there is a total of 15 months here in this period. 15 months. But how many months do we need in this basis period? From April to December happens to be 9. You don't need to count your fingers. All you need to do is January to March, which is not included here, is 3 months. Just take away 3 from 12, is 9. But feel free to count your fingers. So it means that we need 9 months here for this first year. And we are given, the first figure we are given is 15 months. It means we are going to prorate it and take 9 months out of the 15 months. So that's the calculation here, 9 out of 15, and the figure we are given is 1,800,000. So when we do that, we are having 1,080,000. That's our first year figure. Now the second year figure is we are still going to go to the beginning of when the business starts. And so because we go to the beginning, we are still going to take our figures from this first place. Okay? Now, how many months are we looking at here? We said the second year must be 12 full months. So we're looking at 12 months that will end in March 2007. And this is ending in June 2007. So everything, the 12 months is inside this 15 months here. So what do? We say 12 over 15 of that same figure. And we get 1,440. And that's that. We go to the third year. The third year is July 1, 2006 to June 30th, 2007. So what you do, where can we find July 1, 2006? Where can we find July 1, 2006? Of course, this one is ending in June 30, 2007. That means July 1, 2006 must be here. And when is this account ending? This account is ending June 30th, 2007. Exactly where this account is ending. And it is a 12 months account. So our 12 months is inside here once again. So we'll do it again. 12 over 15 times 1,800,000. And we still get the same 1,440,000. Now, because this is commencement of business, always do your right of election, except if the lecturer says ignore right of election. Somebody is saying, how did we arrive at 15 months? And what do? This period started from April 1, 2006. So count April 1, 2006 and end it in June 30th, 2007 is 15 months. And I counted it this way. We have April 2006, 1 month, May 2006, 2 months, June 2006 is 3 months. And I say count from July 2006 to June 2007 is 12 months. Add 12 to 3 is 15 months. So I guess that's clear. Now, we do our right of election by comparing this second, by adding up this second and third year, which are these figures here. We have 2,880,000. Now, because the lecturer or the examiner has not told you to ignore right of election, it means you must do it. So let's see how right of election works. Of course, this year one figure is just for illustration purposes. You are not to do year one figure in right of election. You are not. So you are not comparing. This is just a copy and paste of what we did before. Now, the right of election starts from year 2. And look at it now. It's from January 1 to December 31st, 2007. So ask yourself, where will I find January 1 account? Look at January 1, 2007 is what we're looking for. And here it is, this is June 30th, 2007. That means January must be inside this account. January must be there because this account has ending June 30th, 27. And so you ask yourself, between January 1 to June 30th, how many months is this? It means this is 6 months. So what we are saying is we need 6 months from here, January to June. Then we will get the remaining 6 months, July to December 2007 will be gotten from the next place. So we take 6 out of 15 here, and we take 6 out of 12 here. So that's exactly what we did here. 6 out of 15 plus 6 out of 12. Solve them separately and you get your answers. You add them together, you have 1,470,000. Now that's clear. Now we'll go to the third year. We are looking for January 1, 2008 to December 31st, 2008. So the question is, where can we get January 1, 2008? We are going to get it from here, January 1, 2008. So from January to June 30th, 2008 is 6 months. So we are going to look at 6 months from here. Then the remainder of the 6 months from July 1 to December 2008 will be gotten from here. So 6 over 12 of this, 6 over 12 of this. So that's what we did here. 6 over 12. Sorry, this is not 15. This is 6 over 12. But the answer here is correct. The typo. 6 over 12 of this and 6 over 12 of this. When you sort them out together, you are going to get 1,650,000. Okay? Now, when you add the second and the third year together, you're having 3,120,000. So you ask yourself, is it a good thing for the taxpayer to exercise his right of election and pay higher tax? No. So the advice here is do not exercise right of election. Don't exercise your right of election. Now that's for commencement of business. Now I'll have you know that if you are commencing your business and you are asked to give the basis period for the first 5 years. Now I know why I'm asking this for the first 5 years. You know your commencement rule is only going to affect the first 3 years, right? That's good. Now, the fourth year, how do you continue your business in the fourth year? Now, let's assume we exercise our right of election and we now choose this period, 2007 and 2008. We now choose January 1 to December, January 1 to December. Your next year, 2009, will never continue from rights of election basis. It will never continue, whether you choose to exercise your rights or not. So even if you did not choose this normal basis for the second and third year, your fourth year must continue from where this stops. Whether you exercise your right of election or not, take note, it must continue from where this stops because this is the normal basis. And so if we are to give 2009 year of assessment, it will start from July 1 to 7 and it will end in June 30th, 2008, preceding year basis because your year of assessment is 29. And so the fifth year, 2010, will be July 1 to 8 to end in June 30th to 9, preceding year basis. Take note of that. Okay, so we've seen the first of the abnormal situation, which I call the first C. Now, the first C is commencement rule. Once again, you look at the date the business commenced. You use it in the first year and in the second year. That is the only time you use it. Then, from the third year, the date that is relevant is the date the account is being made up, preceding year basis. Let's look at the second abnormal situation, which is the second C, change of accounting date. Now, you see, when you register your company, and I said before, you are going to give the CAC people the date the business is going to commence, and you are going to give them the date when you are filing your annual returns with CAC. You tell them your account ending date. Now, whenever you think it is necessary for you to change your accounting date, you will also notify both the CAC and the FIRS. Now, what could be some of the things that will make you to change your accounting date? Let me give one example. It could be that your company has been bought over by another company, and previously you have been doing July to June ending, but the parent company is doing January to December. So what do? The parent company is supposed to consolidate these businesses, and so because of administrative convenience, they could ask you to change your accounting date. Yes, the parent company is a different entity, legal personality different from your entity, but because they are now parent, they have controlling interests. They could ask you to change your accounting date. And because of that, you could change your accounting date. Sometimes it could be by law that everybody in this business will have to change. You know, there was some time that the government told the banks to maintain a 31st December every year account. So there are some reasons why you need to change your accounting date, and it's not your fault. Sometimes you may want to take advantage of certain things and you change your accounting date. Now, how do you account for change of accounting date? So you see, it's going to distort the preceding year basis. So that's why it is going to be abnormal. Okay, now, before we go on, let me give you qualities of a normal basis period. A normal basis period will exhibit three qualities. One, it must be 12 full months. So any basis period that is shorter than 12 or longer than 12 is not a normal basis period, but abnormal. And so we saw that in the commencement rule. The first year is always either shorter or is always shorter. The first year of assessment for commencement rule is always shorter than 12, except if your business commences in January 1. That is only exception where it will be 12 full months. Another quality of a normal basis period is that it continues from where the previous basis period ends. What I mean is that if the previous basis period ends on a particular day, the next day, a new basis period would have started. So it's like a chain, or people who are running a relay. Once the person who is coming to you runs to where he's supposed to end and gives you the baton, you start going. So it's like a baton. Where this one ends, the other one starts. So there is no overlapping. There is no overlapping. So if you observe year 1 and year 2, there is an overlapping. And sometimes year 2 and year 3, there will be an overlapping. So it disobeys the second principle of a normal basis period. And the third principle of a normal basis period is the year will end on the preceding year. And it's going to be the only account ending on the preceding year. If you look at year one, it was not a preceding year basis. Year two, the account ended even on the same day, on the same year with the year of assessment. It's only in year three that obeyed that law of preceding year basis. So you see why beginning or commencement rule is seen as abnormal. Now, if you look at change of accounting date, you're going to see some abnormalities that will make it not to obey this three principle of actual normal basis period. Now, how do you treat change of accounting dates? Two methods of treating it. One, you will continue as though you have never asked for change. That means even though you have asked for change of your accounting date, you will pretend as though you have not asked for change. You keep using the old accounting date for 3 years. So you identify 3 years that will be affected. You keep using the old accounting date for 3 years. Then, after that, you will revise your calculation of those 3 years and now acknowledge the change. So you will now use this, for those 3 years, you will now use the new accounting date that you have proposed. Now, just like you did for right of election, where you sum year 2 and year 3, but for change of accounting date, you are going to be summing the 3 years. And unlike right of election, where you choose the smaller one, in change of accounting date, you will always go for the higher one because you don't have any right to choose smaller one. The tax authority reserves the right to choose which one will earn them more revenue. So they pick the higher one for you. That means after these 3 years has been computed, you want to go to the next one. What do? You continue maintaining the new accounting date. Despite the fact that maybe the tax authority may have chosen the figure of the old accounting date as a higher one, do not say, okay, because they have chosen that one, that the subsequent one will be following. No, you've asked for change. So irrespective of whether they choose the old accounting date figure or the new accounting date figure, immediately after that 3 years, you continue with the new accounting date that you've chosen. But the most important question to ask for change of accounting date is, which year is the first year of change? I call it the first relevant year. Now that is the year you experience a change. How will you know that a change has occurred? Okay, from this question we have given of Liadi Trading Company Limited decided to change its accounting year end from March 31 to December 31. Okay, the examiner was so lenient to tell you they have changed from this date to that date. Some will not tell you. They will want you to use your eye to look at the account and know if there is a change. So if you look at the account, this one is being brought in March 2006. So that means, yes, this is March account. But can you see here, it has changed to December 2006. Fine. Now that's one. Secondly, how will you know that a change has occurred? You keep, before the account, you were filing year end, that is complete 12 months. But when you now see period, you know that is not a complete 12 months. It's either smaller than 12 months or bigger than 12 months. That's a red flag. Change has occurred. So that's the point where you now say change has occurred. Then the next thing to ask is, which year of assessment does this change relate to? So when you know the year of assessment that this change relates to, you have identified the first year of change. After identifying the first year of change, identify 2 other years after it. So the next year and the year after are just natural. So the thing to do is just to identify the first year of change. Then ask yourself, which basis period is this? Then you are, I would say you are 80% into getting the answer right. Okay? Now, let's read the question. Its 2007 assessment was based on its account for the year April 1 to 5 to March 31st to 6. That's what they said. They said the account that they gave to the tax people in 2007 is based on April 1 to March 31st to 6. So can you see it here? April 1 to 5 to March 31st to 6. So you see, they are telling you what they just told you here. Okay, now I will want you to do something for me. If you are with this question paper in the exam, they have given you year ended. Just by the side, start writing the year of assessment. Start writing the year of assessment. So what you have here is, if this one is year ended 31st March 2006, of course it's going to be on a preceding year basis. This means that the year of assessment is 2007. 2007. Let's go to the second period. This is April 1 to 6 to December 31st to 6. Which year of assessment is this? This is also 2007. There is a problem. We have 2 accounts for 2007. Now that is one law of normal basis period that is violated here. One of the law of the basis period is that there must be 12 full months. And in fact, even if a month is ending in the preceding year basis, it must be the only account ending in the preceding year base. Now you can see 2 accounts ending on the same preceding year base. So you know that 2007 year of assessment is the first year of change. So we have identified the first year of change, 2007, because the basis period is ending in 26. So after identifying 2007, you identify the other 2 months after it, 2 years after it, 2008 and 2009. Now, how do you treat it? Now let's look at the treatment here. Let's look at the treatment briefly. Okay, we'll be looking at the dates first before we go to the solution. So the first relevant year, which is 2007, you will be doing your analysis based on the old accounting date that is ending in March. I said before, pretend as though you've never asked for change. Keep using March 31st. And another thing you should do is everything for these 3 years must be on preceding year basis. Everything on preceding year basis. So you look at it, year of assessment is 2007. The account must end on 2006. And we said March 31st. So it's March 31st. So it must have started in April 1, 2005. April 1, 2005 to March 31st, 2006. You go again, 2008 year of assessment, where this one stopped, March 31st, 2006. The next day, that is where this one will start. April 1, 2006, go to March 31st, 27. You know, when you are doing something 12 months period and it's on preceding year basis, all you just need to do is to just do copy and paste and increase the year by 1, copy and paste, increase the year by 1. So when you get to 2009, you would have copied everything here down to here, increase the year by 1. So this is 27, here is 28. Now, that is for the year. Now, you go to the based on the new accounting date. What's the new accounting date? December 31st. So that is your new accounting date. So you now acknowledge the fact that you've asked for change. So let's give them the change. This is 2007 year of assessment. Because of preceding year basis, your account must end in 2006. And we said it is December 2006. December 31st, 2006. That means you ask yourself, what is tomorrow's date? January 1. So January 1, 2006 must be the beginning of the accounting year. So what you do now, the next year is 2008. You copy and paste and you move the year by 1. You move it by 1. You go to the third year, 2009, copy and paste, you move the year by 1. Move the year by 1. So you see actual year, it's not actual year basis. So anytime you see January 1 to December 31st, don't just conclude it's actual year basis. Everything we are doing here is preceding year basis. How do we know? Let's look at it. This is 2007. And you check. Year is not 2007. If it was 2007, you would say actual year. But here is 2006, preceding year. So it's actually the year that you use in determining preceding year, not because it starts from January 1 to December. So this is actually preceding year basis. So now let's look at the computation. Okay. Now we said April 1, 2005 to March 31st, 26. This is the same account here. 12 months. So there's no working story. Just bring this figure and take it down here. So that's what we did here. Okay. The second year, we are beginning from April 1, 26 to March 31st, 27. Of course, here is April 1, 26. But you see, it ended in December 31st, 26. So there are 9 months here, and we need 12 months. It means the remaining 3 months from January to March can be gotten from here. So all we need to do is take these 9 months in full, 75,000, then look for 3/12 of this. That's what we did here, 75,000 plus 3/12 of that figure there. Add them together, you have 135,000. Now that's fine. We'll go to the third one. We are looking for what date? April 1, 27 to March 31st, 28. So what do? We'll take April 1, 27. Where can we find April 1, 27? So look at 27 account. This is January to December. So April must be here. So from April 1 to December 31st, that's 9 months. So we are taking 9 months out of 12. The remainder of the 3 months will be taken from here. So here will be 3/12. So here is 9/12 and 3/12. When you add them together, you have 187. Now you sum these three, this 120, 135,000, and 187. They are going to give you this figure. When you sum them up, you keep it on the one hand. Then you go to the new accounting dates. Okay. The first one is 2007 year of assessment. you have to start from January 1, 26 to December 31st, 26. So where do you have January 1, 26? This one end in March 31st, 26. So January must be here. So January to March is January to March. Okay, somebody say I'm breaking. Uh-oh. If you can hear me now, the person will say I'm breaking. If you can hear me now, please go to the chat and say you can hear me. Okay, now this is we're looking for January to December 26, but I've identified that January 1 is here. January 1 to March 31st is 3 months. So we are taking 3 months here out of 12. Okay, then the remainder is April down to December, which is ending. The remaining 9 months is this. So all we are doing is 3/12 of this figure plus the whole of these 9 months. So that's what we did. 3/12 plus the whole of these 9 months give you 105. Then the second year is January 1 to December 31st to 7. January 1 to December 31st to 7. Exactly. We take this figure. That's what we did here. And for the third year, January 1 to 8 to December 31st to 8, and that's here. 28,000. You add them up, and that's giving you 373,000. So what do you think you will choose? This is not right of election. You must choose a higher one. The tax authority will actually choose a higher one. And that's fine. Let me give you a simple trick to do in this exam. Whenever there is a change of accounting dates, always observe in most questions for using the old accounting date, on the old accounting date, you will never do workings on the first year. This is because the first year you were compliant. You will never do workings on the first year. So the first year you will have your figure, you will have the figure that was given to you in the exam will likely be what you just put here. I said in most cases, not in all cases. But you must do workings in the second year and in the third year. You must do working. But there is every possibility that the first year there will be no workings. Going to based on the new accounting date, you will always do workings in the first year. This is because that first year you were compliant based on the old accounting date. And so based on the new accounting date, you were not compliant. So you must do workings. Now, the reason why you do workings in the second and third year in the old accounting date, because you were compliant with the new accounting date. And so in the new accounting date, second and third, you will not do workings. So you are going to be doing a total of 3 workings. For the old accounting year, the second and the third year. The new accounting year is first year. Now, why is it that this does not correspond with the normal basis period? Now, here is it. We've chosen 2000 and we've chosen this figure here, 422, as what we are going to assess you based on the old accounting date. Yes, and because it was based on the old accounting date, maybe 2016, 2006 year of assessment ended in March 31st. Of course, these 3 years will have a continuation of the normal basis period. But when you get to 2010 year of assessment, there's going to be problem. So that's the reason why you say that this is an abnormal assessment period. For 2010 year of assessment, which is a continuation, you have to base it on the new accounting date. And the new accounting date will be January 1, 2009 to December 31st, 2009. There's going to be a gap between April 1, 2008 to December 31st, 2008. There's going to be a gap. And so you see, one of the principles of the normal basis period is there is no gap nor overlap. So because when you have used your new, when you move from the old accounting date to the new accounting date, there's going to be a gap. Okay, let's assume that you choose the new accounting date. It was the one that you choose. Now the problem is your 2006 year of assessment would have ended in March 31st, 2005. March 31st, 2005. And now you've chosen new accounting date. Your 2007 assessment will start January 2006. And so there is a 9 months gap again. So because of that gap, when you are doing change of accounting date, we say change of accounting date is abnormal. So 2 things you should know, or 3 things. Change of accounting date is an abnormal basis period. Secondly, you must do based on the old accounting date and based on the new accounting date. And when you sum your figures, you choose the higher one. And thirdly, for the old accounting date, there will be no workings in the first year, but workings must exist in the second and third year. For the new accounting date, workings will always be in the first year, none in the second and third year. Okay, and one thing again to continue is from your continuation, you have to follow the new dates, the new accounting year end. That is how the continuation 2010 account will continue, irrespective of whether you choose the old or the new one to base your assessment of those 3 relevant years. Now we've done 2 abnormal situations. Let's get to the last one, which is the cessation of business. Okay, now when you were registering your business with CAC and you are filing your annual returns, you were preparing your account based on going concern principle. It means your business is supposed to continue in the foreseeable future. Nobody wants his business to die, but sometimes certain things will make your business crumble. One of them could be the global economic meltdown that we had sometime. It could also become bankruptcy of the proprietor of the business. And if this is not a limited liability company or public liability company where you subscribe to shares, if it's a one-man business or a partnership business, once a member dies, it brings the business to an end. Death of a partner, bankruptcy of a partner, insanity of a partner, or death of the business owner, the business comes to an end. Anything could make a business come to an end. And so how do you treat business that is declined or that have ceased? Another abnormal situation exists here. And I will tell you how the abnormality is treated. Okay? Unlike commencement of business and change of accounting date, where you identify 3 relevant years, In cessation of business, which is a third C, you identify 2 relevant years. Now, which one will you identify first? It is easy to identify the year the business ended. And we will call it a name. We call it the ultimate year. It is easy to identify your ultimate year first. Then you go back one step, 1 year before, and say, oh, if this year 2009 is my ultimate year, that means 2008 was the year before the ultimate year. We call it ultimate year. You may not easily know that's an ultimate year. After all, your business is going to continue. And all of a sudden, your business ended in 2009. You may not have foreseen that. And say, oh, identify the ultimate year first, then go up backward, 1 year backward, and then identify the preceding year basis. And so that is also the mindset that the tax authority has. Because what you will do is the penultimate year, by the time you were filing your accounts with the FIROS, you must have done it with preceding year basis. You must have done it with preceding year basis, with all pleasure that you were doing the normal basis period, that business will still continue. So, but now that the business has ended, go back to your penultimate year and go and treat it based on actual year basis. The law says when you compare your treatment of the penultimate year using preceding year basis with the treatment of that same penultimate year using the actual year basis, the bigger one, the bigger of the two results is what they will accept. The tax people want more money. But I'm surprised your business is ending and they're asking you to pay the bigger one. Well, this is one of the things that we will need to ask them to review. So, but for now, they will take the bigger one out of the penultimate year treated preceding year and actual year. Now you go to the ultimate year that the business ends. They are going to treat the ultimate year based on actual year basis. So now can you say now that actual year basis is not a normal basis period, but in cessation of business, the ultimate year is treated with actual year basis. And penultimate year, we are comparing preceding year basis with actual year basis. For example, if you choose the actual year basis, it means that there's going to be a gap between the year before the preceding year basis and the year before the penultimate year and the penultimate year. There's either going to be a gap or an overlap. Also, there is a tendency that in the penultimate year and the ultimate year, there's going to be a gap. So because of that gap, we say that the cessation period is an abnormal basis period that is being displayed here. So these are the 3 periods that you will see abnormalities. Now let's look at this question and see how we can treat this basis period. Okay, Grace Limited has been in business for many years. Because it has been in business for many years, you will see the pattern in which their account is being filed. As a result of the global economic meltdown, the business declined. Underline the word declined, that's ceased. And Grace Limited ceased, underline that, ceased trading permanently on September 30th, 2009. Identify the dates the business ceased. This date is important because it reveals the year we will call the ultimate year. So our ultimate year is 2009. So when you have identified 2009 as ultimate year, quickly use your pencil and your question paper and say, that means 2008 is the penultimate year. Quickly get that sorted out. 2008 penultimate year, 2009 actual year. Now, if you look at it, year ended, consistently year ended. But when it gets to the time the business ceased, the business did not cease on the account ending date. The business ceased sometime after the last account has been filed. Now, you were asked to compute assessable profit for the last, underline the word, last 3 years of assessment. And anytime you see the word "and," it means your answer is in twofold. So after identifying the last 3 years of assessment, justify the option open to the FRS. So ask yourself, what is the last 3 years of assessment? We'll count it from the last, second to the last, and third to the last. Okay, the last year of assessment must be the ultimate year, 2009. The second to the last must be the penultimate year, 2008. And the third to the last must be 2007 year of assessment. So you see the way I move step backward to identify the 3 relevant years that they need here. So let's see it here. It means I would need 2007 year of assessment, 2008, which I've called penultimate year, and 2009, which is the ultimate year. Let's forget about the workings and let's look at the basis period. For 2007, which is not the penultimate year, you keep filing your tax as you've been doing on preceding year basis. So you go to the question, how have they been filing their account? They have been filing their account ending June 30th every year. So what you do, if this is 2007, your account must end on June 30th, 2006. So go to any account that tells you year ended 2006. That is the account that belongs to year of assessment 27. To help you, you can just use biro to write or pencil to write by the side. If they give you year end, convert it to year of assessment. Year of assessment, it will help you as you are looking at it. So now this is year ended to June 2006. That is your 2007 year of assessment. And straight up, it's in preceding year basis. You bring the figure without any workings. And that's it. Now, the next thing to do is penultimate year is 2008. Now, you must have first of all filed your tax for that penultimate year using the preceding year basis. And for preceding year basis, this is 28. It must have ended in June 30th, 27, PYB. So go to the account having PYB June 30th, 2007. And here it is, 426,000. And that is it here, 426,000. Why am I not putting it here? I'm doing a comparison here, and the winner will be the one to enter this place. Now, I have chosen 426 here, but I don't know if this is what is the final tax, the final assessment, assessable profit that the FRS will choose. But this one is held here temporarily. Then you go back again because the business has ended and you have identified here as penultimate year. Previously, you have done preceding year basis. Go back and do actual year basis. So that means if this is 2008,
your account. Sorry, this is 2008. It's a typo. Your account must be December 31st, 28 and must start with January 1, 28. So you ask yourself, where can I get January 1, 28? It must be here that has June 30th, 28. So from January to June, you have 6 months. So that's what I did here. 6 months out of 12 months. Then the remainder of July to December 28 must be found here. 6 out of this figure. So that's what I did here. 6 out of that figure. So what do? You have 331. But the tax authority will say choose the higher of PYB and AYB. So choose which one of them is higher. Of course, this is higher, and that's why this is choosing here. Now you go to the ultimate year. The ultimate year is actual year. So how do we know it's actual year? Year of assessment is 29. It starts from January 1, 29, and it's ending in the date in 29, the date the business sees. So everything is all on actual year basis. So now this is a 9 months account. It's a 9 months account. So what do we do? Look for where we can get January 1, 29. Where can we get January 1, 29? Just right here. So it means from January down to June is 6 months. So we're taking 6 months out of 12 here. That's what we did here. 6 months out of 12. Since we are looking for a total of 9 months, getting 6, then this must be the remaining 3 months. So we take the whole 19,000 as the remainder of the 3 months. We add it up, we have 151,500. Now, you see there's a gap. Let me show you the gap. Shebi, we use 426 as our choosing figure, which is this, right? There is no gap between 27 and 28. But between 28 and 29, there is a gap. Here ends here June 30th, 27. And here is starting January 1, 29. So what happens to July 1 down to December 27 and the whole of January to December 28? So there is a 15 months gap. Is it 15 or 16? Yeah, 16 months. 18 months. A whole 6 months plus 12. 18 months gap between the penultimate year and the ultimate year. You know, preceding year, commencement rule and cessation rule, you could have a gap as high as 23 months or as low as 1 month. You could also have an overlapping basis period as low as 1 month or as even high as 23 months for the first year to the third year. So you see why these are abnormal basis period. Somebody is saying, please explain the ultimate year. The ultimate year is the year the business ended, and you are going to use only actual year basis. I wrote it here, actual year basis. How do you know actual year basis? This is 2009. It must start from January 1 of that same tax year, and it's ending 30th September of that same tax year. He said he didn't get the 15 months gap. The 15 months I'm trying to explain here is between 2008 and 2009. Now, the tax authority chose 426 as a figure it will base its account. And it was based on July 1, 26 to June 30th, 27. Now, the next year, which is 29, started from January 1, 29. So between June 30th, 27, where the former one ends, to where this starts, there is a 15 months gap. Let's count it from July 1, 27 to December 31st, 27 is 6 months. Then from January 1, 28 to December 31st, 28 is 12 months. Now that is 18 months. It's 18 months I'm talking about, not 15. It's 18 months gap. So between where this one stops and where this one starts is a 15 months gap. Nobody is going to ask you that in exam, but I'm just telling you why they are, for you to know that there is a gap. That is why it is abnormal basis period. Nobody is going to ask you that. All they will ask you is to calculate. Now, the FRS will choose the higher of the two accessible profits on the penultimate year when they are accessing the company to tax. So far, so good. We've looked at the three abnormal situations. I call them the 3 C's. Let me reiterate what I've said about them. In the commencement rule, or the commencement of business, the first thing you are going to look at is the date the business started. So the date and the year the business starts is your first year. It will be based on actual year basis. From the date the business starts to December 31st of that same year. Now, the second year will still take the date the business starts as its beginning of its basis period. But this time is going to be 12 full months. So to start from the date the business started, count 12 months. And I have a principle of counting it. If I'm counting 12 months forward, what I normally do is I ask myself, what was yesterday's date? And I'll bring 1 year forward. That is how I count 1 year forward. But if you can't do that, I don't have time to explain it online here. But if you can't do that, use your fingers. Count 12 months. Okay? The third year is the preceding year basis. How do you do the third year? You base your end date on the choosing accounting date. So your choosing accounting date, you count 12 months backward. It must be 12 months ending on the preceding year basis, not actual year basis this time. And so how do I count 12 months backward? If I'm standing at the ending date and I want to count 12 months backward, I ask myself, what is tomorrow's date? I'll put tomorrow's date as the beginning, then I'll take 1 year backward. That is how I will count it. Otherwise, if you can't do that, count your fingers. Okay, we go to this change of accounting date, and I said 3 years are relevant. Identify the first relevant year. That is the first year you fail to bring your account on the choosing accounting date. Identify the basis period. In fact, identify the year of assessment associated with that first year where you failed to continue bringing your account according to the account ending date that you've chosen. Identify 2 other dates, 2 other years after it. These are the 3 years. Then what you do is you assess them based on the old accounting date. You pretend as if you never asked for change. After that, you also do it according to the new accounting date. You compare the 3 years and you get a higher figure, is what you give to the FRS. I omitted something in a commencement of business. That is the right of election. The right of election, the 2 years, the second and the third year of business, you have the right as a taxpayer to assess yourself to tax based on actual year basis. Simply because, and you say, okay, why don't you continue for the other 2 years, actual year? If it's going to favor me, fine. But if not going to favor you, don't embark. Now, for the cessation of business, you identify 2 years. It is easy to identify the ultimate year first. Then you go 1 year backward and say the year previous to business end, identify the year, call it ultimate year. Then go 1 year upward and identify the year that is the penultimate year. What do? You treat the penultimate year in 2 ways. You treat it based on preceding year basis. You also treat it based on actual year basis. And you choose which one of them is higher. That's what you give to the FIROS. Now that you've done that, I have a jaw-breaking question, or will I say a hand-breaking question that summarizes everything we've done for today. It may not be possible for me to finish this question. So anyway I end, that is the remainder is an assignment for you. Let me try as much as possible to use the next 25 minutes to finish this. CAN Limited commenced business. So I've underlined the keywords commenced business on October 1, 2001. So this is the date relevant to commencement. Remember, you are going to use this date twice. The first year and the second year. The company, however, chose December 31st as its accounting date. Now, one thing you will know from this question is the accountant, I don't know if I will call him daft. He did not obey that. He kept bringing October 31st. I don't know if they told him that the business is ending October 31st. He kept bringing October 31st. Or the company forgot that they told CAC that October 31st and December 31st is their choosing accounting year. So what you are going to do for me is, despite the fact that they brought this thing October 31st, is a deliberate thing, you are going to adjust this account to comply with the fact that your account ending date is 31st December. That's the first major working this question has. Now, in tax year 2006, I underline it is relevant, the company wrote to FIROS notifying the Revenue Service of its intention to change its accounting date to May 31st. So it means old accounting date, December, new accounting date, May. Now, can you see here that they have changed to May? They have changed to May. Every other thing was year, but you see, here is period. There's a red flag here. Of course, this is commencement, and of course, this is cessation. That means this must be the change of accounting date, period. Okay, so they said in 2006, they have told you your first relevant year. This is a hint to tell you your first relevant year, 2006. And if you look at it properly, this is a basis period that belongs to 2006 year of assessment. And here it is not a full 12 months. So this is your year of change. The company said they want to use 31st May, and that's fine. You know how you treat it. 3 years identified, old accounting dates, Based on new accounting dates, compare figures and choose the higher. Later in the year 2010, due to harsh economic recession, the company collapsed and folded. What have they told you here? They have told you your ultimate year. So if you look at it here, January 31, 2010, that is your ultimate year. This is the date the business ends. What does that tell you? 2009 is your penultimate year. So if I were you, I would just go down here and write 2009 penultimate year. So that as you are solving, you'll be keeping track. Whenever you get to 2009, you know you treat it as penultimate year. Okay, now look at the whole accounting figures that we are giving to you. Required. Applying the rules of commencement, change of accounting date, and cessation of business, find the assessable profit for all 10 years of assessment from 2001 to 2010. Now, I'm going to do something for you. You will do the rest for me. I'm concerned mostly on interpreting the basis period. You will give the answers, the figures. So let's look at it together. And okay, now we said that the business commenced on October 1, 2001. That must mean that this period started from October 1, 21, and is ending October 31st, 21. How many months is in this period? 1 month. 1 month is in this period. But look at your first basis period. Your first basis period, the normal commencement rule. We are going to choose from 1st of October to 31st December. 1st of October to 31st December. So how many months make up this period? October, November, December. 3 months. But here, we have been given just 1 month. It means we must find the other 2 months here. So that means we'll take this 1 month and look for 2/12 of this figure. And that's what we did here. 1 month plus 2/12 of this figure, it gives me 35,500. Beautiful. Now let's get to the second year. The second year, we also have to start from when the business commenced. October 1, 2001, we'll count 12 full months. And I said to myself, what was yesterday's date? 30th of September. And I'll add one more date, one more year, 2002. So it starts from October 1, 30th September. Okay? Now, because we still start from the same date this other one starts, we'll acknowledge this 1 month. And this is a 12 months figure. We need additional 11 months. So we're going to say plus 11/12. And that's what gives me these figures. So for the first time now, I'm going to put it here because I don't know whether it qualifies to go here and here because of right of election. Somebody is asking me to explain the first year of commencement again. The first year of commencement is always actual year. It starts from October 1 of 2001 and must end in December of that same year. But you were given only October 1 to 31st account. It's not complete for our purpose now. We need November and December. Where do you get it? It's here you will get it. November and December is just 2 months. And this is year-end figure. This is 12 months figure. So you take 2 months out of 12 and you add it to this 18. which is what I did here. This is the 1 month, 18,000, and I've done 2/12 of this figure. For year 2, we are still starting from the beginning of the business. So I'm still taking my 1 month. Then I'm taking the remaining 11 months to make it 12 months from the following year, from the following account. Now, mind you, I put my answers here. Going to the 3rd year. The 3rd year is where the preceding year is supposed to commence. So what happened? This is 2003. You know your answer must end in 2002. That's fine. You go back and check when are they bringing their account. December 31st. So you come now and say December 31st, 2002. Now you've complied with preceding year basis. Ending your account on the chosen accounting date, preceding year basis. So what do? You count 12 months backward. So if it's end in December 31st, it must have started January 1, 2002. So that's fine. So what happened? Where can you get January 1, 2002 account? Of course, it must be here. January 1, 2002 account must be here because this one ends in October. So November of 2001 is here. December, January is here. So from January to October is 10 months. Meanwhile, we need 12 months, but we can get 10 months here. So we say 10 all over 12, which is what I did here. 10 all over 12 of that figure gives me 87,500. Then I will need the remainder of the 2 months from here. So I will say 2 over 12 of 120. So when I add them, this is what I will get. Now, mind you, because you are going to do change of, you are going to do right of election, you are going to add these 2 figures and look at what it gives me. Now you are going to compare. Now I've gone now to right of election. In right of election, I'm only doing year 2 and year 3. And how am I doing it? I'm doing it based on actual year basis. So you see here is 2002. It must start January 1, 22 to December 31st, 2002. Question is, where can we find January 1, 2002 account? Certainly here. From January to October, it's 10 months. So I'm taking 10 out of 12 here. Then November and December can be found here. 2 months. I'm taking the remaining 2 months here. 2 out of 12. So that's exactly what I did here. And I got this 107,500. Then going to 2003, I'll still use actual year basis. It means 2003 corresponding with the year of assessment. January 1. Where can I find January 1, 2003 account? Of course, here. So from January 1 to October 1 to October 31st, rather, is 10 months. So I'm taking 10 months from 12 months here. I'm taking the remaining 2 months here. And so that's what I did. So you see, I now looked at these 2 figures here. I looked at this and that, and I found out that this figure here, using the normal commencement period figure, this one is smaller than this. So you see the reason why I am taking this figure and this figure here. Point of note, don't go and start comparing this figure with this figure and say this one is smaller, then you choose this. Then you come and say this figure and this figure and say this is smaller. No, you don't compare year 2 and year 2 and choose the smaller, then compare year 3 and year 3, choose the smaller. No, you must take the two as a whole, sum them, and compare it with the sum of the other one. Whichever gives you the lower result, you take the 2 years that give you that result. Now, notice again that I want to continue my basis period. And I told you, never ever continue from right of election, whether you choose right of election or not. Continue from where you stop with your normal basis period. So look at what is it. This stopped at December 2002. So the continuation must be January 1, 2003. Preceding year basis, 2004 year of assessment, ending in December 31st, 2003. So you ask yourself, where can I get January 1, 2003? This is it. 10 months out of 12. The remaining 2 months is gotten here. That's clear. Then we go to 2005. 2005. It must continue where this one stopped. So all I will do here is I will just say copy and paste. I will just increase the year, increase the year. This is 2005. Okay. Where can I find January 1, 2004 figure? Of course, it's going to be here. January 1 down to October is how many months? 10 months. So I'm going to do 10 over 12 here. Then the remaining 2 months, I'm going to get it here. But now, how many months make this period? How many months make this period? Now, this period would have started from November 1, because this old one ended in October 31st. So it must have started in November 1. So let's count. November, December, January, February, March, April, May. 7 months. So it means I will take 2 months out of 7. So that's exactly what we did here. 2 months out of 7. In addition to 10 months out of 12. And you see, you give your answer here. Remember, the question says in tax year 2006, that's the year of change. So you have identified that the next one we are going is year of assessment 2006. So you know that is the year of first year of change. You know you are going to do change of accounting date. So what you do now is based on the old accounting date. Now this is your year of assessment 2006. What do? Everything will be on preceding year basis. So it means this 2006, everything must end in 2005. What is the old accounting date? Old accounting date is December 31st. So you see, it's ending in December 31st, 25, preceding year basis. Ask yourself, where can we find January 1, 2005? January 1, 2005 can be found here. January to May is how many months? 5 months. And this period is a 7 months period. So we are doing 5 out of 7. Now that we've gotten 5 months, we will need 7 more months to balance it to make it 12. So the remaining of the 7 months is taken here. So this place is 7 over 12. So you come here and say 7 over 12. That's fine. And you have 137, 786. So once again, I'm not writing in the last column, I'm writing in the first column because I'm going to do a comparison between this and that. Okay, now that we've done the first year of change, the second year of change is 2007, preceding year basis. So you're just copying this date and putting 1 year forward, 1 year forward. So you ask yourself, where can I get January 126? January 126 can be gotten here. It means from January 1 to May, you have 5 months. 5 months. So you are taking 5 out of 12. So I'm taking 5 out of 12. Then the remaining of the 7 months is taken in the other year. 7 out of 12. Then you go to 2008. It's a basis period, preceding year basis, ending in 2007. So you ask yourself, where is January 127? It's found here. From January to March, that's 5 months. So I'm taking 5 months out of 12 months. Then I will take the remaining 7 months out of 12 months here. Now, if you notice, I told you before that if you are given change of accounting date, you not do workings in the first year, in the first one, but you must do workings in the second and the third. Now, why did you do workings here? Because you have been doing workings all along. It is because the accountant or the company did not bring their account ending in December. They were bringing it ending in October. That is why we did workings here. But can you see, based on the new accounting date, there was no working in year 2 and year 3, but there's working in just year 1, like I told you. Now, when you add them up, let's look at the change of accounting date briefly. You look at it, you go back to 2006 year of assessment. You ask yourself, what's the basis period? We said the account is now ending in May. So it must have started in June. So you see why sometimes I will prefer to ask myself, what is tomorrow's date? For fear that I may go and say April. If I'm standing in May 31st, ask myself, what's tomorrow's date? It's going to be June. So the account must have started in 1st of June, 2004, ending in May 31st, 2025. Ask yourself, where can I get June 2004? Go to 2004. You must have got a June account here. So from June to October, how many months? June, July, August, September, October. So I'm taking 5 months out of 12. And that's it, 5 months out of 12. Then the remaining 7 months, it is this period. This is a 7 months period. I'm just going to take the whole 90. So 5 out of 12 plus the remaining 7 months period. And that gives me this. Okay? Then give me a moment, let me plug my charger. Okay. All right. Now, this is 7 months period. So you add them up together and you have 152,500. Now you go to 2000 and what did they call it? 2007 year of assessment. You are going to do copy and paste from June 2005 to May 2006. So you go to the account ending in May 2006. So you see it's year ended. You just bring the figure and put it straight down here. The same thing applies to 2008 accounting year. We bring this figure without workings and put it down here because it complies. Now you add these three together, you are getting 458,500 as against 433. The FROS will choose the higher one. So that's why we are choosing this one, and that's why I'm putting them here. Now, we've just done 2006, 2007, 2008. Before you continue, I told you 2010 is your ultimate year. So that makes 2009 your penultimate year. So we've just finished 2008. Now, the next starting, we are entering is 2009, and that is your penultimate year. And so cessation rule would have started. So look at the cessation rule, 2009, penultimate year. We have to first of all choose preceding year basis. How do we determine the preceding year basis? You must continue with the new accounting date. You must continue after you've done your change of accounting date and you want to continue. You must continue following the new accounting date, whether you choose the old accounting figure or not. Continue the dating with the new accounting year. So for the PYB, it means that where this one stops, that is where this starts. Sorry, this is 2007. It's a slight correction. This is 27. June 1, 27 down to May 31st, 28. Preceding year basis. Just go and take the figure, 2008 figure. This is what we're talking about. Preceding year basis. Then you come back and do your actual year basis. Come back and do your actual year basis. January 1, 29 to December 31st, 29. Ask yourself, where can I find January 1, 29? I can find January 1, 29 here. That means January to May is 5 months. So I'm taking 5 months here out of 12. That's exactly what I did, 5 out of 12. Then I will need the remainder 7 months. So I will go and check the remainder of 7 months must be here. So from June, and this is ending in January ending. So from June to January of the following year is June to December is 7 months. So to January of the next year is 8 months. So I've taken 5 months here. I'm going to take 7 months out of the 8 months. So that's what I did here, 7 out of 8. And I've gotten this here. So I'm doing comparison, 110 and 108. Which one of them is higher? 110. That's why I picked the higher figure. Now the last one is the 2010, the ultimate year. Of course, I'm going to use actual year basis. January 1 to December, to 31st January is 1 month. 1 month. And where can I find my January 1 figure? I'm going to find it here. So from January 1 to December 30 to January 31st, 1 month, but this is an 8 months figure. So I will say 1/8 times that gives me 7.5 that I'm using here. So you see, this one question, I want you to go back again and do it again and again and again. If you can just understand just this question, then your problems for basis period will be over. If you want to contact me after the class, if you have any issues, feel free to look at my phone number or to look at send me an email if you wish, and let's talk. Well, I want to be keeping to time. I don't want to keep you much longer than necessary. We have just 1 minute. I would say that any question you have, send it to the WhatsApp group where you got your link. So once again, thank you so much for coming to class. I believe the class has been informative, it has been educative, and we are going to pass your ICANN exam this time. So whether you have written this exam more than once, I've known people who have written it like 5, 6, 10, 9 times. This year will be the year in which you're going to make it. So thank you so much for coming to class, and we'll see you in the next class. Thank you so much.